Good morning, everyone, and thank you for joining. My name is Hajra Talat, and I will be your host for today's webinar on transfer pricing compliance in the UAE. So before we dive right into the webinar, I would like to give a brief introduction about our company. ACME Group has formally established itself in the GCC region and Egypt as a reliable provider of tax services, financial services, advisory, compliance services for the businesses operating in the region. We provide high quality solutions catering to our clients in the multiple industries and diverse sectors. Our strength lies in our expert team members and their capabilities driving us to rapid expansion. Moving on, I would like to give a brief introduction for today's webinar's speakers, Ms. Aditi Bhoj and Ms. Tanya Thomas. Ms. Aditi Bhoj is a senior tax manager with more than 7 years of experience in international taxation, with her core expertise in transfer pricing, having co-authored articles on transfer pricing implications on franchise arrangements as well as on profit split method. She is an active panelist on transfer pricing in the UAE with various taxation societies. She has been actively assisting and advising multinational clients from different industries with their cross-border transactions and taxation treaties and ensures they comply with complex taxation regulations in the UAE. In addition to being an international tax expert, Ms. Tanya Thomas is a tax associate with the Distinguished Professional in Accounting and Taxation. She holds a degree in commerce and is an ACCA affiliate. Ms. Tanya has developed a robust expertise in transfer pricing impact assessments and macroeconomic factor revisions in line with IFRS standards. Her role in transfer pricing advisory involves meticulous analysis of cross-border transactions and double taxation avoidance agreements, ensuring full compliance with regulatory requirements. So before we dive right into the webinar, I kindly ask our audience of today to share their valuable questions on the subject in the Q&A section. This will contribute to an interactive session and ensure you derive maximum value from participation. Your participation would be important to the success of event. I would now like to move on and invite and hand over the stage to Ms. Aditi and Ms. Tanya to commence the webinar. Over to you, Ms. Tanya and Aditi.
Thank you so much, Hajra, for the wonderful introduction. So, before we dive deep into the presentation, first of all, I'd like to take the audience to the content which we would be covering today. As you can see on the slide, we would be covering the overview of transfer pricing regulations. First of all, we discuss how did the regulations evolve worldwide in the major economies. Moving from that, we'll discuss about the genesis of transfer pricing in the OECD provision, and we'll also talk about the growth of transfer pricing regulations in the UAE. Not just that, we would cover the frameworks, regulations, who are related parties, who are connected persons, how do they exercise control, what is the three-step approach for doing transfer pricing, in which we'll talk about the FAR analysis, the economic analysis, we'll talk about the transfer pricing documentation as well. And to conclude the presentation, we would talk about the key takeaways and the areas which are still gray areas with respect to the transfer pricing provisions in UAE. We can move to the next slide, please. Next slide, please. All right. So to start off the discussion about the development of these provisions globally, we'll discuss about how transfer pricing regulations were adopted by the major economies in the globe. Let's say in Australia, the transfer pricing provisions were introduced in 1981. After that, the major economies, which are major trade partners globally, which are United States of America and the United Kingdom, introduced these provisions in 1990 and in 2010, respectively. Moving from there, when we talk about the Middle East markets, Egypt was one of the first countries to bring about the transfer pricing provisions in 2005. Now, as you all are aware, that till date and today, Saudi Arabia plays a major role in the trade globally. Now, Saudi Arabia first introduced these provisions in 2019. However, they kept on evolving from 2019. In 2020, the ZATCA made certain changes. They further made changes in 2023. And the final transfer pricing bylaws in Saudi Arabia, which are effective now, got effective from 2024. Also, not to leave behind Qatar. In Qatar as well, these provisions came into the picture in 2019. We can move to the next slide, please. All right. So, as I previously discussed in the content section, we have talked about the genesis of international taxation. Now, what is international taxation and where does it have its genesis? So, as you're aware, the Organization for Economic Cooperation and Development, which is OECD, has the base for transfer pricing provisions and the international taxation provisions globally. Now, the OECD first came into the picture in 1979. After that, the fiscal committee invited various recommendations, various consultations, and in 1995, they came up with new regulations. Now, as the businesses were evolving and as the economies were developing, 2010 played a major role globally when the OECD guidelines were first issued, and they covered an important aspect of business restructuring. Now, when this aspect was introduced in the OECD guidelines, what happened was that many companies across the globe started a particular practice. And what was that practice? That practice was parking of excess profits from a high tax country to a low tax or a no tax country. Let me give you an example there. For example, if we take the example of United States of America, where the taxes are as high as 40%. Many multinational groups in United States of America started opening their subsidiaries, affiliates, step down subsidiaries in no tax jurisdictions such as Cayman Islands. Now, once these profits were getting parked and once the taxes were getting evaded in the major economies, the OECD stepped into the picture. And what happened was that in 2015, they introduced a robust and meticulous action plan, which was called BEPS Action Plan. I'll tell you a little bit more about BEPS. Now, BEPS covers 15 action plans which target to eliminate evasion of taxation globally. Some of the most important action plans in the BEPS are Action Plan 1, which talks about significant economic presence by digitization, Action Plan 8 to 10, which talks about intangibles, and Action Plan 13, which talks about documentation. Now, let me tell you the importance of Action Plan 13 today in UAE. As you are aware, Action Plan 13 talks about a three-tier documentation, which is a local file, master file, and country by country report. Now, these have also been enacted and accepted in the UAE. So that is the importance what BEPS has globally over all economies. After BEPS got introduced, more businesses came into the picture, they were making more changes, and financial transactions also became of utmost importance globally. Now, OECD rightfully came into the picture again. It took into factor that financial transactions are also happening, and the regulations were modified yet again in 2020, and financial transactions aspect got covered. Now, from 2020 to 2022, the OECD invited multiple consultations and recommendations from the taxpayers as well as the industry payers. And after taking all these recommendations into perspective, they revised the regulations. And till now, as on date, the regulations which we are following globally are OECD guidelines for 2022. We can move to the next slide, please. All right. Very interestingly, on this slide, what we have done is we have covered how the transfer pricing regulations came into picture in UAE. As most of you would be wondering that the law got incepted in June 2023. So that is came. Well, let me make a value addition there. The case is not so. FTA has been very pragmatic and very meticulous, and 2020 onwards, they decided to bring about the provisions. They had a vision to bring about transfer pricing provisions in the foreseeable future. The reason is that in 2020, they issued a cabinet decision wherein they defined what is a multinational company. They defined what are the revenue thresholds. They defined who is the constituent entity. After that, they moved forward. They invited recommendations from taxpayers, and in 2022 January, the Ministry of Finance in UAE made a very happy announcement that they would bring about corporate tax law in the UAE. Now, this law was published in the official gazette in October in the same year, but it became effective from the next year, June 2023. Once it became effective, now several changes were happening, businesses were evolving, taxpayers had multiple questions to ask the FTA. And these questions revolved around an important aspect, which was transfer pricing. To answer all those questions and to concise the provisions together, they published a transfer pricing guide last year in October. Now, this guide is a robust guide which offers various clarifications to most of our questions around transfer pricing. We can move to the next slide, please. All right. So, with that, first thing we'll talk about is the concept. After the concept, we'll move to framework, and after the framework, we'll move to the three-step approach for transfer pricing. Now, as you are aware, transfer pricing provisions in UAE are there as a part of Article 34, 35, and 36 of the UAE Corporate Tax Law. Now, let me tell you one more interesting point. These provisions are applicable not only on cross border transactions, but also on domestic transactions. And how is that so? I will give you an example. Let's say there is a company in mainland and it is transacting with its subsidiary in free zone. Now, this transaction also has to comply with transfer pricing laws. And by that, we mean that the transaction between the free zone company with its subsidiary or affiliate at mainland has to be at fair market value. So, domestically, yes, transfer pricing provisions are applicable. Secondly, of course, yes, cross border transactions wherein a UAE entity is having a subsidiary, affiliate, or a group company outside UAE. If they transact amongst themselves, then they also are subject to transfer pricing. One more interesting point here is that transfer pricing is applicable not only on mainland entities, but also on free zone entities. As many of you would be thinking that are free zone entities exempt from transfer pricing, then unfortunately the answer is no, because free zone as well as mainland, considering their legal status, are subject to transfer pricing provisions in UAE. We can move to the next slide, please. All right. So as we just previously discussed the example, we have given the same example on this slide, wherein we have explained how does a cross-border transaction happen, how does a domestic transaction happen, and how are transfer pricing provisions in place. Now, for cross-border, let's say subsidiaries are outside UAE, main entity is in UAE, they have a transaction. Now, this transaction may be a purchase, sale, or any services transaction, but it has to be at fair market value, which is arm's length. Similarly, domestically, if a free zone entity has a group affiliate which is in mainland, any transaction, again, the nature could be any. It could be purchase, sale, or services. If such transactions are happening, then yes, they also have to comply with the arm's length standard. And how they have to comply, how the benchmarking is done, how the FAR is done, of course, we will cover in the later sections of the presentation. We can move to the next slide. All right, very interesting. That brings us to the first poll question of the day, wherein we ask you that are the transfer pricing provisions in UAE applicable on cross-border as well as domestic transactions? I'm sure would answer it correctly. You have 30 seconds to answer. Your time starts now. Thank you, everyone. And as we have the responses from the audience, most of you have answered it correctly. Yes, transfer pricing provisions are applicable not only on cross-border transactions, but also on domestic transactions. We can move to the next slide, please. All right, very interesting. So now, after the concept, we'll talk about the framework. And in the framework, we've interestingly covered three aspects. What was the need to bring about transfer pricing in UAE? On who is it applicable? And what is transfer pricing? Let me talk you through each aspect one by one. Now, when I talk about the need, as we discussed, to ensure that there is no tax evasion and to put an end to the parking of excess profits from a high tax country to a low tax country. Transfer pricing provisions were kicked in, basically to avoid the aspect of base erosion and profit shifting. The base of the profit should not get eroded, the excess profits should not get shifted. That was the need, and that was the need of the hour to bring about such provisions in UAE. Now, the second aspect on who are these provisions applicable? As we previously discussed, they're applicable on related parties, on connected persons, and they cover within their ambit free zone entities also and mainland entities also. Now, who are related parties? Who are connected persons? We will discuss that in greater detail as well in the subsequent slides, but let me just give you a gist here as well. Now, related parties are entities who have 50% or more shareholding, voting power, board of directors share, sharing of profits in one entity in the other. They would be considered as related parties. Secondly, who are connected persons? Any director, owner, officer of a business who has a significant influence over the key strategic decisions of a business is considered as a connected person. So, any payment made to such connected person would be considered that it has to be at arm's length. Transfer pricing would apply on such payments being made. Yes, now how would we test these payments? How the benchmarking would be done? Of course, we will cover those aspects in the subsequent slides. Now, the third aspect on this slide is transaction pricing. Now, what is transaction pricing? What is transfer pricing? So, as we just discussed, it has to be at arm's length value, which is nothing but the concept of fair market value. I'll tell you what is being followed in UAE. In UAE, the FTA wants that we conduct a detailed economic analysis, a detailed benchmarking analysis to come out with something called as an interquartile range. Yes, the term might sound heavy, but I'll try to simplify it for you. Now, interquartile range is something which is a range between a 25th percentile and a 75th percentile. So, the net profit which our company, which the tested party is earning, should be within that range, and that range is determined for the comparables in the market. We will discuss that in greater detail as well. Next slide, please. All right. So on this slide, what we have discussed is who has to comply with arm's length and who does not have to comply with arm's length. Now, going by a simple logic, as most of you would agree with me, when we talk about industries which are regulated, for example, companies which are listed. So companies which are listed are highly regulated by the federal governments in a country. By virtue of being highly regulated, their transactions are 99% of the time already at fair market value. So, in those situations, of course, transfer pricing provisions would not apply because the government understands that regulated industries always function at arm's length. Secondly, who do these provisions apply on? Like we previously discussed, related parties, connected persons, mainland entities, free zone entities. And when these provisions apply, these entities have to ensure that they satisfy the arm's length test, which is the finding of an interquartile range. We can move to the next slide. All right. So, as I discussed in the contents also, what we've done in this presentation to make it very simplified for the audience is that we've divided the entire concept into a three-step approach. First, we'll identify the transactions, then we'll do a FAR, and then we'll do an economic analysis. Let me walk you through each of these three aspects one by one. Now, how do we identify the transactions? These transactions, as we mentioned, may be related parties or any payments to connected persons. Now, let me give you an example. Related party transactions, very interestingly, can be between group affiliates, group companies, wherein a purchase might be happening, a sale might be happening, or a service might be getting rendered, or a service might be getting availed. Such transactions are considered related parties. What are connected person transactions? Now, this aspect of connected persons transactions, we understand and we believe would be highly litigated by the FTA once they begin the assessment. Now, the reason for that is the law says in UAE, who is a connected person? Any director, any owner, any officer of a company who takes care of the strategic decisions of the business. Basically, somebody who's the head and brain of the business would be considered as connected. And the FTA has also said that any payments which we are making to such individuals, which may be in the form of comprehensive salary package as well, let's say which comprises of your fixed part, your bonuses, your incentives, your variables, your allowances, all that, whatever is being paid should be at arm's length price. Now, let me tell you, as most of you would be wondering, with respect to connected person transactions, how would we determine the arm's length price? Yes, that is a very interesting thing to think. The reason behind that is connected persons' payments are subjective. Let's say somebody is a general manager or somebody is a chairperson. The roles which they may be undertaking may be same, but the designations, the name of the designations may be different. So there is a detailed analysis which is done in this case of connected persons. We have to check the number of years of experience they have. We have to check what is the salary being paid to them. We have to check their educational qualifications, so on and so forth. So basically, that is how we first identify the transaction. Now, once we identify the transaction, then we move to one of the core aspects of transfer pricing, which is FAR analysis. Now, what is FAR analysis? Why is it done? How is it done? What result does it give us? Let me tell you one by one. Now, FAR is a determination of the functions which each entity does in the entire group, assets which each entity owns, who has the fixed asset register, in whose name is the tangible asset, in whose name is the intangible asset, and who assumes which risk. Let's say one entity in the group may be assuming a market risk, but the other entity in the group may be assuming a credit risk, whereas one entity may be assuming a pricing risk, an inventory risk, so on and so forth. So that varies for each business, right? And how do we understand this? Yes, so I'll tell you the approach which is followed. So the approach is that we conduct detailed functional interviews and we conduct site visits. Now, when these site visits and when these interviews are conducted, we speak with the key managerial personnel of a business to understand what are the functions, which entity does what, which entity has intangibles, which entity assumes which risk. Now, once this entire interview process is complete, then what result do we arrive at? I'm sure many of you would be thinking. So, the result which we arrive at is the correct and accurate characterization of that entity. Okay, so I'll tell you how can the entities be characterized. Now, practically, as the audience is aware, the entire industry or market is segregated into three major sections: manufacturing, distribution, and service provider, right? Now, for manufacturers, there can be three types of manufacturers. They can be licensed manufacturers, they can be toll manufacturers, they can be contract manufacturers, right? We'll also discuss what does each manufacturer do. Secondly, for distributors, how many types of distributors can be there? There can be limited risk distributors, there can be full-fledged distributors. All right. And for service providers, also two types of service providers can be there, right? There can be a high value adding service provider or a low value added service provider, which can be a routine service provider. What do they do? Don't worry, we will discuss in the subsequent slides. Now, after we complete the second step of this three-step approach, which is FAR, after that we move to another important step, which is the economic analysis. As all of you are aware that one of the most rampant terms which is being discussed now in the UAE is the benchmarking. Yes, we will discuss about benchmarking as well. We will talk about how is benchmarking done, what is a profit level indicator. All right. So once we understand that what is the correct characterization of an entity, we determine the profit level indicator, which means that we see what is the net profit margin of an entity. Then we compare it with the market. Once we compare it with the market, we arrive at an interquartile range, which is 25th quartile and 75th quartile. Now, our net profit should lie within this interquartile range. That is the essence of the benchmarking analysis. That is the essence of transfer pricing. How it is done, yes, we will discuss in the subsequent slide. Next slide, please. Interesting. That brings us to the second poll question of the day. And I'm sure after this detailed discussion, the audience would definitely answer it correctly. And the question is very simple, my friends, which is transfer pricing applicable on related parties as well as connected persons? You have 30 seconds to answer. Your time starts now. Well, thank you, everybody. And yes, the audience did not disappoint us once again because majority of you think and you agree that transfer pricing provisions are applicable on related parties as well as connected persons. Thank you. We can move to the next slide, please. All right. So now that brings us to the first step of the three-step approach, where first we'll identify, interestingly, who are the related parties. Now, in this slide, we have detailed that in a very simplified manner for the audience to understand. Now, related parties extend up to fourth degree of kinship or affiliation, which can be successors, predecessors, or the peerage, right? Up to fourth degree of kinship. Secondly, I will tell you in a very simplified manner, if one entity has more than 50% voting power, has more than 50% shareholding, can elect more than 50% of the board of directors of the other entity, or has more than 50% share of profits in the other entity, they will be considered as related parties. And not to leave behind another important aspect, which is permanent establishments, right? So if let's say a free zone entity has another office in outside UAE, let's say in Djibouti, which is in Africa, and there are core activities which are being done from the Djibouti office, so the permanent establishment rule has to be checked for UAE in Djibouti and for Djibouti in UAE because it can be vice versa as well. So all these circumstances we have to assess, all these circumstances we have to understand to come to a conclusion whether we are becoming related parties or not. And on this slide, I'd like to explain you one more aspect, which is the fact that the such ownership or such shareholding, such voting power may be direct as well as indirect. Let's say A has shareholding in B and B has shareholding in C. So indirectly, if A has more than 50% shareholding in the step down subsidiary, which is C, then A and C would be considered as related parties. We can move to the next slide, please. All right. So now the second transaction which we'll identify after we identify related party transactions are the connected person transaction. All right. I'll tell you again, as we discussed before, who are connected persons. Now, connected persons can be directors, they can be owners, they can be shareholders, they can be officers of a business. Now, there is one gap in law till date in transfer pricing because FTA has not defined which officer would be considered as a connected person. Now, this aspect is open-ended. It would be highly litigated by the FTA once they start the assessment because they have not clarified who would an officer be. But practically speaking, once we interact with the businesses, once we understand how they work, what inference we have drawn is that people who are taking key strategic decisions, people who are the heads and brains of a business, would be considered as connected persons. Now, the law here says that any payment which you are making to such connected persons has to be at fair market value. And what do we mean by such payments? Now, these payments can be salaries, they can be bonuses, they can be fixed pays, variable pays, incentives, so on and so forth. Such payouts which a company makes have to be at arm's length price. We can move to the next slide, please. All right. So on this slide, what we are talking about is we are talking about control. Who do you think would exercise significant control over the business operations? Now, somebody who has more than 50% shareholding, some entity which has more than 50% voting power. Also, if an entity has the right to elect more than 50% directors of another entity's board of directors, then in all these circumstances, it would be considered that one entity is exercising significant control over the other entity. And when this happens, we say that significant control is being exercised or implemented by one entity or the other. And because of this, that is by the virtue of exercising such control, we will say that they become related parties. We can move to the next slide, please. All right. So now that brings us to the second step of the three-step approach. Now, first step, as you all must be remembering, was the identification of the transaction, which we just covered, how to identify related party transactions, how to identify connected person transactions. Now, the second step of this approach is FAR. What is FAR? We will discuss it step by step, and I will explain in a very simplified manner for everyone to understand. So far is nothing but functions, assets, and risks, right? How do we determine this? We conduct detailed site visits, we conduct detailed interviews with the key management of a company to understand that in a group, which entity performs which function, to understand which entity has which assets, who is the owner of tangible assets, who is the owner of intangible assets. And we also discuss with them that which entity assumes what risk, which entity is the one which is holding the inventory, which entity is the one which is determining the pricing, which entity is the one which is highly affected by any significant changes in the market. So likewise, these risks become inventory risk, pricing risk, credit risk, and also foreign currency risk. And foreign currency risk, let me tell you, is one of the most vital ones. The reason is that in all the cross-border transactions, what happens is that the payments happen in different currencies. So if one entity is making payments to another sister company in a different currency, so by virtue of foreign exchange fluctuation, that gives rise to the vital foreign exchange risk. So basically, in FAR, three aspects we cover: functions, assets, and risk. And how it is done is we conduct site interviews, we conduct functional interviews, we conduct site visits to understand that who is doing what. Now, how do we do it? The reason behind that is because we have to understand that on the basis of the functions which are being performed, the profits would get delineated. Every entity would be allocated a profit depending on the function which it is performing. Let's say if somebody is performing a high intensity or a high quantum function, accordingly, the profit share which would go to such entity in the group would be higher as compared to the other entity. That is the reason we perform this. And what is the end result we arrive at? So, after we perform the FAR analysis, the end result we arrive at is the characterization. All right. Now, what is characterization? Characterization is different for different sectors of the market. All right. Let me tell you now, the market has three sectors. It has manufacturing, it has trading, and it has services. Manufacturer, as we discussed, can be of three types: licensed, contract, and toll. Distributors may be limited or full-fledged. Service provider may be an entrepreneurial or a routine service provider. We will discuss these as well. We can move to the next slide, please. Okay. Now, another important thing which has been under litigation in most of the countries globally and in the major economies is the aspect of profit attribution. Now, as we just discussed in the previous slide, once we do the FAR, we understand which entity would be given how much profit share. Once we understand the delineation of such profits, the profit can be attributed. But had it been so simple as it is said, but unfortunately that's not the case. Because once we determine who undertakes what function, it becomes very difficult practically to attribute the profits. Currently, there is no standard formula in any law across the globe which talks about what is the percentage of profit which should be attributed. All right. So that aspect we know and we believe would be under litigation once the assessment starts in UAE as well. That is what profit is being attributed to what entity, depending upon what functions, what assets they have, what risks they assume. So yes, this would be a severe matter of litigation in the future. We can move to the next slide, please. All right. So here in this slide, we will finally discuss about the characterizations which we've been talking about. Now, manufacturers can be licensed, contract, and toll. Now, what is the difference between the two, between the three? I'll explain one by one. Now, somebody who is a licensed manufacturer is a full-fledged manufacturer. They have their own factories, they have their own warehouses, they have their own intangible properties also, which may be goodwills, which may be APIs, which may be patents, trade names, trademarks, brand names. All right. Then, who are contract manufacturers? Contract manufacturers are the ones who are given instructions from the licensed manufacturers. On the basis of the instructions which they receive from the licensed manufacturers, they undertake the production or assembly of the goods. All right. But there is a key point which we should note, which is that in case of contract manufacturers, the raw material is not given. All right. So the licensed manufacturer gives the instructions to the contract manufacturers as to how to produce the goods. But the important thing is that they do not give the raw materials. So what happens is that the difference in the risks which are getting assumed, licensed manufacturer is assuming high risk, but the contract manufacturer is assuming low risk. The reason for that is that it functions on the basis of the instructions which are given. Okay. Now, what is the difference between contract manufacturer and toll manufacturer? Now, toll manufacturer is the one who is given not just the instructions, but also the raw materials. Accordingly, the risk which this toll manufacturer receives or which this toll manufacturer assumes is way more less than a licensed manufacturer. Okay. I think by that you will understand the difference between the three types of manufacturers. Now, if I talk about the distributors, Interestingly, there are two types of distributors. One is a limited risk distributor, second is a full-fledged distributor. Now, a limited risk distributor is a part of the entire supply chain of distribution, which means what? Now, when I talk about distribution, the supply chain is vast. So, the supply chain of distribution covers not just procurement, not just logistics, but it covers marketing also. It covers sales also. It covers packaging also. It covers after sale services also. In this entire chain, limited risk distributor is a part of a very small portion. Maybe they're only into procurement, maybe they're only into purchasing and selling the goods, and not involved in the entire supply chain for distribution. Accordingly, let's say if there is any damage of goods which happens at the port. Now, in that case, will the limited risk distributor bear the risk? The answer is no, because the title of the goods may not be getting transferred to this limited risk distributor. And since the title is not getting transferred to this limited risk distributor, because of that, they would not be bearing high risk. After that, if we talk about full-fledged distributor. Full-fledged distributor is a distributor which is involved in the entire supply chain of distribution. Basically, a full-fledged distributor performs end-to-end all the functions of the supply chain for distribution. All right. So full-fledged distributor is a distributor which bears supremely high risk if in case there is any damage to the goods which happens because the title has been transferred to the full-fledged distributor, then yes, he would be responsible to bear that loss. Okay. Now, with that, we can talk about the service provider. So, interestingly, the service providers also are of two types. They can be high value service providers or there can be low value service providers. High value service providers are the entrepreneurial ones. They would bear majority of the risk. And the low value service providers are the routine service providers. Let's say they are involved into not core activities but only ancillary or incidental activities. And because they are involved in these ancillary or incidental activities, they bear way more less risk than a entrepreneurial or high value service provider. Okay, we can move to the next slide. Interesting. That brings us to the third poll question of the day. I'm sure the audience would definitely answer it correctly because of the detail in which we have discussed all the aspects. And the question is that is the identification of tangible as well as intangible assets necessary for FAR analysis? You have 30 seconds to answer. I'm sure you'll answer it correctly. Your time starts now. All right. Overwhelming response from the audience. And yes, majority of the people have answered it correctly that this identification is necessary and mandatory for both, for tangible assets also, as well as for intangible assets. Thank you. We can move to the next slide, please. All right. Now that brings us to the third step of our three-step approach, which is the economic analysis. Let me tell you, friends, economic analysis is one of the most important aspect along with FAR analysis in transfer pricing. What do we do in economic analysis? First step is that we determine the most appropriate method. There are five methods plus another method, which is any other method which the law has prescribed. Where have these methods come from? So the UAE government is following the OECD. They are completely in compliance with the international laws and the international guidelines. And because of that, these methods are there in UAE also. I'll include as well. So So cup method is a method which does an apple to apple comparison, like an absolute comparison. When do we use cup? I'm sure many of you already know the answer. So we use cup in case of any intangible payments, any royalty payouts, any trade name payout, any brand fee payout. We use cup method to find similar royalty arrangements, similar trademark agreements, so on and so forth. And how do we do it? We have separate databases for it, such as Royalty Stat, wherein we perform the cup analysis. Now, when I talk about the second method, which is the cost plus method. So the cost plus method is covered in case of manufacturers. Yes, most of the manufacturers follow plus method. Who follows resale price method? Resale price method is a method which is prevalent across traders globally. I'll give you an example. In case of Japan, the Japanese Sogo Shosha companies who are traders involved in high fee sales, they follow Berry ratio as a part of a profit level indicator in resale price method. Yes, now, if these three methods are not getting applied, then what happens is that there are two more methods which the taxpayers consider. Let's say there are two entities and both the entities are intrinsically involved in undertaking functions with each other. They have a significant role in the functions which are getting performed, and let's say both these entities own intangibles. In that case, what will happen is that, very interestingly, we will apply a profit split method. Now, how is this method applied? Now, in this method, what happens is that the entity which is performing greater functions or the entity which is assuming greater risk, the returns or the profit share allocated to that entity would be more, and the entity which is performing routine functions in the value chain would be allocated something which is called as a residual profit. That is how profit split method is applied. Now, in case taxpayers are doing the workings, they're doing the economic analysis, but in case the market is such or the business is niche that none of these four methods can be applied, then what to do next? I'm sure everybody is wondering. What we have to do is we have to resort to the simplest and the only method of last resort, which is TNMM. That method is the simplest to apply. Why? Because we take a net profit margin to understand what is the profit we are earning, and we simply compare it with the profit which the comparables are earning in the market. That is the simplest method to apply, friends. Now, the FTA has also talked about any other method. It has said that in case the taxpayers feel that they have another method to justify their transactions, let's say they have certain valuation reports in construction industry, let's say they have a DCF approach, or let's say they have an NAV report by doing capital budgeting. Those kind of reports also can be used as a corroborative evidence, and the taxpayer can use any other method to justify those transactions. Okay, we can move to the next slide, please. Next slide, please. All right. So in this, what we have done is we have briefly talked about what is benchmarking, how is it done. Now, here in UAE, the transfer pricing guidelines which are there, they have not given the hierarchy of any specific method which is to be selected. They have left it to the discretion and intelligence of the taxpayers to practically assess their business, to practically assess their transactions, and to select the most appropriate method for benchmarking. And how these benchmarkings is done is that a detailed analysis is done on the publicly accredited databases to come up with an interquartile range. Also, the FTA has not specified which particular database they would prefer. Okay, we can move to the next slide, please. Now, yes, in this slide as well, we have discussed the same that benchmarking is important in the pre-scenario, which is the current ongoing tax period for most of the businesses, which is January to December. We must undertake the benchmarking right now. Why? Because after this tax period, when we file the corporate tax return in 2025, at that point, we have to furnish something called as a disclosure form. That is why benchmarking is important in the pre as well as in the post scenario. We can move to the next slide, please. All right. That brings us to the second last poll question for the day, wherein we are talking about documentation. And I'd like to ask you all, what do you think? Are all companies required to maintain master file and local file? You have 30 seconds to answer. Your time starts now. Thank you everyone for responding. Let me tell you, we have received mixed responses. That is the reason we have covered this aspect also in our presentation. So let me tell you that not all companies are required to maintain local file and master file. If a company crosses a threshold, a particular threshold in law, which we'll talk about, only then they have to do these compliances and documentation. We can go to the next slide, please. Now, that brings us to transfer pricing documentation. I'll quickly run through this slide and I'll talk about the mandatory ones and I'll talk about the subjective to threshold one. So, friends, the thing is that a transfer pricing disclosure form is a mandatory requirement. It has to be filed along with your corporate tax return in 2025. In that, you have to furnish details about your related party transactions, your connected person transactions, the methods you are following, everything. So that is mandatory. What is subjective? What is subjective is the local file, master file, and country by country report. The law says that if you're crossing 200 million dirhams threshold at a company level or 3.15 billion dirham threshold at a group level, only then you have to comply with these. I'll quickly tell you what is a local file, master file, CDCR. Local file is nothing but a local transfer pricing study wherein we talk about the transactions at a local level, we talk about the industry, we talk about the functions, economic analysis, so on and so forth. Master file comprises of the group structure. There we talk about the value drivers, the competitors, how is the market functioning globally. All those aspects are covered there. And a country by country form is a statistical form wherein we have to talk about the stated capital, authorized capital, revenues, taxes, etc., etc. So these are the four transfer pricing documentations. We can move to the next slide, please. Okay, as we just discussed about what is mandatory and what is not, transfer pricing disclosure form, friends, yes, it is mandatory. Local file, master file has to be furnished subject to a threshold. When do we have to furnish that? Once the FTA calls upon us, once they send us a notice requesting for the local file or master file, 30 days from the date of receiving of this notice, we have to submit these with the FTA. Next slide, please. All right. That brings me to the last poll question of the day, wherein I'd like to ask you a very simple question, which is that does a transaction between a company and its affiliate need to be at arm's length price? You have 30 seconds to answer. Your time starts now. Well, thank you so much. Yet again, an overwhelming response, and almost everybody has answered it correctly that yes, transactions between companies with their affiliates, group entities have to comply with arm's length standard. Next slide, please. All right. With that, we've come to a very interesting slide where we've talked about the areas of concern. As you're aware, although the transfer pricing guide has been published in October last year, in October 2023, but there are still some gray areas. The important ones I'll tell you. As you're aware, globally, to cut down the protracted and long drawn litigations, the government authorities have introduced dispute resolution mechanisms. They have faster dispute resolution mechanisms in the form of APAs and MAPs, as well as safe harbor rules. But till now, in UAE, APAs, maps, and safe harbor rules have not been introduced. What we understand from our experience of working in GCC is that over the years, once the assessments start, after the filing of the corporate tax return in 2025, once the litigation starts, I'm sure the FTA would definitely devise the quicker, faster resolution mechanisms to cut down the litigation and to cut down the protracted assessments which go on. We can move to the next slide, please. All right. With that, we come to the last slide for today, which is the key takeaways. What we have done is we have summarized all the slides in this one slide. How did we begin this presentation? We talked about the concept of transfer pricing. It has its genesis in OECD. We talked about cross-border transactions, domestic transactions, their applicability for free zones also and mainlands also. We talked about the framework. We discussed what was the need of bringing about such regulations, on who is it applicable, and how is such transaction pricing determined. Moving on from that, we talked about the three-step approach, wherein very meticulously we divided entire transfer pricing into three aspects. We identified the transactions, we talked about FAR, we talked about economic analysis, and at the end, after performing the FAR, what did we arrive at? We arrived at the correct characterization of an entity. And in the entire industry, it can be different for manufacturers, different for distributors, and different for service providers. Now, with that, this brings me to the end of the presentation, and I'll hand over the podium to Hajra. Over to you, Hajra. Thank you.
Thank you so much, Ms. Aditi, for making the session so insightful and engaging. It was an overwhelming response that we have received in the Q&A session. And now, moving on, there are so many questions from our audience. So without further ado, we'll move on to the Q&A section. And in the meanwhile, additionally, we have launched the feedback section as well. So I would like our audience to kindly refill the feedback form. So your feedback will be valuable to us and will help us in improving our future sessions. So I'll invite Ms. Aditi and Ms. Tanya to start with the Q&A from our wonderful audience.
Thank you, Hajra, and thank you, Aditi, for such an engaging session. Now, moving forward with the Q&A session, we have received an overwhelming response. So we start with the first one. So the first question is from Mr. Thomas. What happens if Free Zone Company has a subsidiary in mainland and they enter into trading transactions?
Thank you so much, Tanya, for that question. Well, yes, that is a question which has been asked by multiple clients and multiple players as well. Now, what happens is that if, let's say, a free zone entity has a subsidiary or any group affiliate in mainland, right? The first thing is that they will be considered as related parties, and whatever transactions are happening between them have to be at arm's length or at fair market value. What do you think, Tanya? What are your inputs on that?
As rightly said, Aditi, any transactions being conducted with the related parties or connected persons should be in line with the arm's length price, and appropriate documentation should be also maintained by them.
Yes, thank you, Tanya. We can move to the next question, please.
Now, moving to the next question, we have it from Mr. Kumar. As per transfer pricing laws, is it mandatory to charge profit to related parties?
All right. Thank you for that question as well. Now, when we talk about charging profit from related parties, now there is a concept of a cost plus markup. It is advised that when transactions are happening between related parties, those transactions should involve a markup. Why should they involve a markup? The reason for that is that since one entity is rendering services to the other entity, so one entity must charge a markup or a fee for providing those services to the other entity. Why? Because they would definitely charge a profit when they're providing such services to a third party. Because of that, yes, it is mandatory that a profit element or a markup should be involved. What are your views on that, Tanya? What do you have to say?
Yes, rightly said, Aditi. At least a minimum of 5% markup should be always maintained when any transactions are being conducted with the related parties.
Right. So, as you rightly said, about 5%. So, as we had discussed previously, also in the transfer pricing guide, they talk about the concept of low value added services. So, if one entity is providing low value added services, such as HR services, such as IT services, bookkeeping services, which are routine in nature,
Hmm.
so the law in UAE has said that such transactions should have a minimum cost plus 5% markup, which should be involved. So, yes. Next
Yes,
question.
Aditi. Thank you. Now, moving to the third question, we have it from Ami. Will interquartile profit range for specific industries be an information that is publicly available, or do companies have to carry out their own benchmarking?
Okay. Thank you, Miss Amy, first of all, for that question. Yes, your question is appropriately drafted as well. So, when we talk about the interquartile range, then this data the FTA would definitely maintain confidentiality about, right? Now, let's say the interquartile range for one company or one business can be different from the other one, right? Every business have to ensure and every business has to maintain these documents for its own self to furnish to the FTA. And what we understand is that the government would definitely maintain confidentiality. These ranges would not be available publicly. Detailed searches have to be done on the publicly accredited databases to arrive at the interquartile range. Now, let me tell you what would be available publicly is that what is the margin in the industry which is generally getting earned. Now, those margins cannot be a perfect indicator which can be perfectly similar or perfectly comparable to your business. The reason is that each industry is separate, each business is separate. The revenue of each business also differs. Because of that, one business cannot be having an apple to apple comparison with the other business just on the basis of a range which is available. And the reason of that is that the range for each business has to be calculated separately, having a separate analysis, and one absolute range, even if it is available in the public sources, cannot be used as a scientific basis for determining the fair market value. What do you have to say, Tanya, on that? What do you think?
I totally agree, Aditi. As you rightly said, in order to maintain confidentiality, FTA does not publish such information. However, there are publicly recognized institutes which are involved in such aspect of analysis. So we can do research on those websites and do, but again, those information which is available, we cannot completely dependent on them.
Yeah, so just to add to that, Tanya, as you're aware, now when we talk about connected persons,
Hmm.
so for payments to connected persons, what happens is that there are certain HR consultancies like Robert Fitch is there, Hayes is there, RFS is there, all right, then Michael Page is there. So reports which have been published by them in the databases can act as a source. However, a detailed analysis has to be done to ultimately arrive at the arm's length price.
Yes,
Thank you.
Aditi. Now, moving forward to the next question, we have it from Miss Sandhya. What are the threshold values that a company should be required to meeting in order to maintain the transfer pricing documentation?
All right, thank you, Ms. Sandhya, for that question. As we discussed in the slides also, when we talk about transfer pricing documentation, so now the mandatory one is a transfer pricing disclosure form. Now, this transfer pricing disclosure form, Ms. Sandhya, you have to furnish and you have to submit it along with your corporate tax return, all right, in 2025. So, irrespective of the threshold of your revenue, irrespective of your profitability, this disclosure form has to get submitted. Now, what is not mandatory and what is subjective is the local file and the master file. So the law has categorically said that if you cross a threshold of 200 million dirham at an entity level or 3.15 billion dirhams at a group level, then you have to maintain local file, master file. You must maintain it. It is advisable in the first tax period, which is ongoing. When do you have to submit? You have to submit it once the FTA calls upon you for submission of the same. Once they send you a notice requesting for your local file and master file, then you have to submit it within 30 days from the date of receiving that notice. What do you think, Tanya? Any different views you have in that?
No, Aditi, this is what it's rightly said. As long as the company is not, their revenue is not going above 200 million dirhams, then in that case, the only documentation which they have to file is the transfer pricing disclosure form. But in case their revenue exceeds 200 million and at a group level 3.15, then in that case, a master file and local file will also have to be maintained.
To add to that, Tanya,
Yes.
I'd also like to clarify one more point is that when we talk about the master file,
Hmm.
now does every entity has to submit it if it crosses 3.15? The answer is no. If any entity is headquartered in UAE
Hmm.
as a parent entity, so that headquarter company in UAE has to furnish the master file of the entire group with the FTA. Now, if your parent is, let's say, situated in Germany, then they have to furnish the master file as per the German tax laws. So, this threshold for 3.15 billion would be considered if the parent is headquartered in UAE.
Thank you, Aditi. Now, moving forward with the next question, we have it from Harjeet. In the related parties, if the arm's length pricing is not maintained due to some reasons, then what will be the consequences faced?
All right, Mr. Harjeet. So when we talk about the consequences, if the fair market price is not getting met, if the arm's length range is not getting maintained by a business, then as we are aware, the FTA has multiple penalties which it may impose. So if the arm's length standard is not getting maintained, so first thing is that they will impose a penalty on the business. Second thing is that they will do an adjustment. And what do we mean when we say an adjustment? Now, globally and in other GCC countries also, what is happening is that in case the taxpayer, the business, falls outside this interquartile range, then what happens, Mr. Harjeet, is that the FTA or the government in that country, what they do is they make certain adjustments. They ask you to add back things to your profit to ensure that your profit increases. Yes. So what happens is that I'll give you examples. There can be a working capital adjustment which can happen. They can ask you to do a working capital adjustment to ensure that your net profit increases. So those are the kinds of things or those are the consequences which are there in case the arm's length standard is not getting satisfied. What do you think, Tanya? In your experience, what have you observed in this aspect?
It is always necessary for any transactions that is being conducted with someone who is a related party with the organization or it's a connected person, that is any director or the owner of the company or a partner in an unincorporated partnership. Whatever transactions being conducted should be in compliance with arm's length pricing, and also appropriate documentation for such transactions should be maintained.
To add to that, Tanya, when we talk about appropriate documentation, as we are aware that such documents are advised to be maintained for 7 years.
Yes.
Yes. So all the agreements, intercompany bills, debit notes, credit notes, invoices, everything should be in place to safeguard the business from the FTA and to safeguard the business from any penalties in the future.
Yes, Aditi. Now, moving to the next question, we have it from Mr. Mohammed. Are there any specific specifications to determine the control or influence one entity has over the other?
All right. Thank you, Mr. Mohammed, for that question. Okay, when we talk about control. Okay, so when we talk about control, as we had discussed as well in our slides, control not only means significant influence, it also means that if we are the head and brain of the business, if we are taking care of not only the important decisions, but we are also the ones who are delegating the roles and responsibilities. We are also the ones who are taking care of the strategic decisions of one company from a different country. If those categories or those criterias are getting met, that means that if we are exercising significant control, if we are responsible for taking care of the core decisions, let's say if we are formalizing strategies, we are making the pricing policies, we are determining how the supply chain should function, in those cases, it is said that significant influence or control is getting exercised. What do you have to say, Tanya? What do you think?
Yes, Aditi, rightly said. And to add to this, as you rightly said, as long as one entity has a minimum of 50% ownership in the other entity, and also this entity is involved in, making the key strategic decisions for the other organization, then in that case, it will be considered as this entity having significant control or influence.
To add to that, Tanya, to add to that, along with the 50%
Mm.
ownership, 50% voting power, 50% share in the profits, 50% selection of the board of directors, if one entity does for the other entity, then yes, both these entities would be considered as related parties by virtue of common control taking place.
Yes, Aditi. And then any transactions being conducted between these entities will have to be in compliance with the arm's length price.
Absolutely correct, Tanya. Absolutely correct.
Now, moving to the next question, we have it from Mr. Sean. What happens if salary payouts to directors include both a fixed plus the variable part? How will benchmarking be done for them?
First of all, thank you, Mr. Sean, for putting that question. We have been facing that question from multiple clients also. Now, what happens is that when we talk about the salary payouts to directors, now directors are considered as connected persons. So, such salary payouts may be fixed, variable. So, the benchmarking has to happen for the comprehensive package. We have to arrive at a interquartile range, wherein we will talk about a range of salaries which will comprise of fixed part, variable part, allowances, bonuses, incentives, everything together. Until now, the FTA has not clarified any particular way of doing the connected persons benchmarking. However, there are few aspects which may be considered, such as number of years of experience, their educational qualification, how many years they have invested in the same company, so on and so forth. Those criteria we have to assess. On the basis of that, research has to be done in detail, and then we can say whether the salary payouts are happening in arm's length standard or not. What do you think, Tanya? What's your experience on connected person so far?
Now, in this case, as you rightly said, when the salaries are being paid out to a key managerial person, now that salary includes both a fixed amount, it includes the allowances, the benefits, the bonuses that is being given. So in such a situation, again, as we discussed before, there are HR consultancy firms who does the benchmarking and releases salary guides online. But again, in order to do a detailed analysis, which is in line with the organization's activities, the roles and responsibilities being carried out by these personnel, then in that case, it is required to have a detailed analysis pertaining to that specific industry.
Rightly said, Tanya. The benchmarking has to be done in detail. Indicatively, we can use publicly available data, but yes, let me tell you that will not be enough because every organization every company, every market, every industry having various sectors are performing niche functions. So we have to do the analysis of the salary payouts in detail.
Thank you, Aditi. Now, moving to the last question for the day, we have it from Miss Richa. Is it mandatory for the holding company to allocate its cost to the subsidiary company in the form of management fees?
Thank you, Ms. Richa, for that question. Now, when we talk about holding company, there are two aspects which can be contemplated here. Now, there is a concept of board activities, shareholder activities. Okay. Now, that aspect is contradictory to the aspect of intra-group services. So, by virtue of a company being a parent company, it has to undertake certain activities for its subsidiary. Let's say it has to organize shareholders' meetings, it has to organize board meetings, so on and so forth. Now, if for those services it thinks of charging something to its subsidiary, then as per law, that is not advisable. The reason is that those services are not considered as intra-group services. Those services are considered as shareholder activities. And why are those services being undertaken? Because one entity is the parent or the holding company of the other entity. However, there can be a separate situation wherein the holding company is rendering some services to the subsidiary. Now, in the services which are getting rendered from the holding company to the subsidiary company, there is a lot of value which is getting added in this entire chain of the service getting provided. Now, to have a commensurate benefit assigned to this value which the holding company is having on the subsidiary company, it is advised that a markup on the cost which the holding company incurs to render this service, a markup should be added and a markup should be charged by the holding company from the subsidiary company. So, yes. What do you think, Tanya? What do you think? Should a markup be charged? Should a markup not be charged? How should such transaction be taking place?
As you rightly said, Aditi, it depends on what kind of transaction is being conducted between the holding company and its subsidiary. If the holding company is performing some of the roles and responsibilities as a parent company, what it should actually perform, then in that case, a markup shouldn't be charged and it is not advised by the law. But on the other hand, if services are being provided by the holding company to its subsidiary, then in that case, yes, it is advisable to charge a markup.
Yes, thank you so much, Tanya, for answering that correctly. With that, we can hand over the podium to Hajra to take it forward and to close the webinar. Thank you so much, everybody. Thank you.
Thank you so much, Aditi. Thank you so much, Tanya, for making this session so insightful and so engaging. We are getting such an overwhelming response on the webinar that people are still pouring their questions down. But due to time restraint, we cannot take any more questions. But you keep putting your questions in, and our team will reach out to you, and we will make sure to assist you in any way possible. Well, thank you so much, everyone in the audience, for joining us and sharing this enriching experience. Your presence and active participation have truly made this session valuable and impactful. We look forward to connecting with you again in the future webinars. And until then, for any further queries, questions related to excise, VAT, corporate tax, kindly drop us an email or give us a call. The details are mentioned on the screen. And thank you so much for filling our feedback forms as well. It will help us to improve our future sessions. Thank you so much and have a good day ahead. Bye.